We were looking at the data earlier, and the reality is the IRS has begun a massive crackdown on side hustles. And unfortunately, it doesn't matter whether you're making $500 a month or $5,000. You see, a lot of people have this misconception. They think the IRS is only looking for the billionaires, the guys with the private jets, the Elon Musk, and it's simply not true. Actually, the complete opposite is happening. Right now, the focus is shifting to something called the microeconomy. Why? Well, because that's where the volume is. They know there are billions of dollars sitting right there. Hey, my name is Karan. I'm a tax strategist at keepmost.com. And today we are going to look at exactly how the IRS is identifying these accounts. Who are they looking for? What are the specific triggers? Look, we've identified 4 specific mistakes that are triggering the crackdown. And listen, if you're building something on this side, you need to know how the IRS is looking at and plotting on the money you make. So first, I want to get on the same page about what a side hustle actually is. In plain English, if it's money earned outside a W-2 paycheck, you are effectively a business owner. Think about it for a moment. Think platforms like Uber, DoorDash, Etsy, Amazon. Think freelancing, consulting, design, social media. Think digital wallets, PayPal, Zelle, Venmo. Even if you call it seasonal or a hobby, if you provided a value and got paid for that value, the IRS sees that as a reportable transaction. So at this moment, you might be asking yourself, Karan, why does the IRS care about my little $2,000? I'm a small fish. And the answer is simple. It's automation. You see, the IRS isn't sending an agent to knock on your door. They don't have the manpower for that. Instead, they are using a system called the AUR, Automated Under Reporter. Think of it like a giant matching game. It compares what you report on your tax return to what the banks and apps report about you. And when a platform or person sends a 1099 to the IRS, it goes into a massive database. If your return doesn't match that number, bank says X, you say Y, boom. The system automatically prints out a notice CP2000. Now, it's not an audit yet, it's just the IRS saying, hey, we see a discrepancy here, explain yourself. So how do we avoid that letter? Well, we avoid these 4 common mistakes. Okay, so mistake number 1, and this is the one that gets everybody. It's the small numbers myth. You probably saw the news, right? The IRS raised the 1099K limit back to $20,000 for 2025. So you're sitting there, maybe you made $5,000 on eBay and you say, I'm good, no form, no tax. And that right there is the trap. You see, there is a massive difference between reporting and taxability. The form might not come, but the tax is owed on every single dollar. Even if you make $400, you still have to file. If you don't report it because you didn't get a piece of paper, that is technically tax evasion. Now, mistake number 2 is the waiting by the mailbox trap. I see this one happening all the time, right? They wait for a 1099 form to arrive in the mail. If it doesn't show up, they think, great, I'm safe. But they forgot a rule. You see, you are required to report income whether you received a form or not. You see, forms get lost, emails go to spam. But if the IRS got a copy and you didn't, I never got the letter just isn't a defense strategy. So as someone with a side hustle, as a business owner, I want you to trust your own records, right? Not just what arrives in the mail. Now, mistake number 3 is the myth of being app anonymous. You have a lot of people who think that because the money is sitting in Venmo or PayPal, it's somehow sitting in a secret vault that the IRS can't see. And look, I get why you would think that. Maybe you kept it under the $20,000 limit, so you didn't get a 1099 form. Or maybe you had a client send it as friends and family. We all know that trick, right? So you're sitting there thinking, I'm good, I'm invisible. The IRS isn't looking at my phone. But let's play this out for a second. Unless you plan to keep that money in Venmo forever, eventually You're going to do what? You're going to transfer that money into your real bank account to pay your mortgage, your groceries, buy a car. And that is the moment that the trail is created. At that point, the IRS doesn't need to hack your apps. They just look at your bank statements. If they see a $500 deposit hitting your checking account every Friday, they're going to ask a very simple but logical question. Is that a gift from grandma, or is this business income? And if you can't prove that it's a gift from grandma, they're going to treat it as income. So just be aware of that trail so you don't get surprised later. Now, mistake number 4 is something called co-mingling. This is the number one thing that causes headaches for most new entrepreneurs and people with side hustles. This is when you mix business expenses with your personal expenses like groceries and Netflix subscriptions in the same checking account. When you do this, you lose the ability to clearly see your ordinary and necessary business expenses. To avoid this, be sure to open a separate account. And to be honest with you, it doesn't even have to be a business account if you're a sole proprietor. Just a separate personal account dedicated only to the side hustle. This creates a clean ledger. It makes you look like a pro, and it makes tax season a whole lot easier. Now, stay with me here because there's a larger debate happening right now, and that is the hobby versus the business debate. And this is where it gets sophisticated. Let's say you report the income, but you report a loss. And you're thinking, great, Karan, I lost money this year. Well, the IRS computer says, wait a minute, this guy keeps losing money year after year. Is this a business, or is he just having fun? Now, their next move isn't just to check your math, it is to reclassify your business as a hobby. So let's look at why that's dangerous. If they tag you as a hobbyist, they can disallow your deductions. So say you used a few of the 90 plus deductions and credits found at keepmost.com. The IRS will let you keep the income and pay tax on it, but they will strip away your write-offs. And suddenly, you owe thousands of dollars on a business that didn't even make a profit. So how do you fight this? Well, you simply have to prove a profit motive. The IRS uses a 9-factor test to decide if you are real or just playing around with this so-called side hustle. You need to win at least a few of these factors to bulletproof your deductions. The first is manner of activity. Do you have books and records, a separate bank account, or are you using a shoebox for your receipts? The next one is expertise. Are you studying how to do the job better? Watching video like this even counts. Time and effort is the next one. Are you putting in consistent hours? Next is the expectation of appreciation. Are you building an asset that will actually grow in value? Then we have success history. Have you succeeded in other businesses before? Then we have history of income and loss. A startup can lose money, but a business that loses money for 10 years in a row is likely a hobby. Then they're going to look at occasional profits. When you do actually make profits, how big are they? Next, we have financial status. Do you rely on this income to pay bills? If yes, it looks more like a business. And lastly, we have personal pleasure. Is this just for fun? So what does all of this mean? Well, you don't need to be perfect on all 9, but you do need to operate with intent to make profit. If you treat it like a business, the IRS is also forced to treat it like a business. Now, let's talk about how to handle the notice CP2000. Let's say you open your mailbox and there is a letter from the IRS. It says notice CP2000 and it proposes that you owe $4,000. First of all, do not panic here. Do not ignore it, but do not just write a check immediately either. Here is a step-by-step protocol that you should follow. First, read the proposal. You see, the CP2000 is not a bill, it is a proposal. The IRS is saying, we think you owe this based on our data. Do you agree? Second, verify the data. Go look at your own records. Did they double count income? Did they miss a deduction? Often, the IRS computer assumes the worst case scenario. Third, you want to check the response form that the notice comes with. You have 3 options. Agree, you sign it, send the check, case closed. I do not agree, you check this box, and in that case, you must attach a signed statement and documents like receipts and bank statements proving why their number is wrong. And then you have partially agree, which means that you agree with some, but not all. And the last thing to confirm is the deadline. This is critical. You usually have 30 days. If you miss that deadline, they issue something called a statutory notice of deficiency. Now, if the error is theirs, and it often is, a simple, well-documented letter typically fixes it. In some instances, you may need to get a tax attorney or CPA involved based on the level of severity, but typically not. So let's avoid that altogether. This is how to stay audit proof. You see, being an entrepreneur is hard enough without having to look over your shoulder from the IRS. So here's the professional approach. Keep contemporary records. Do not wait until April. Use a simple spreadsheet or app to help with this. Then verify your 1099s. When you get a form, check it against your own math. If they are wrong, let them know. Then we have the profit motive. If you want to deduct expenses, treat it like a business. Keep receipts. Then save for taxes. Put 25 to 30% of your profit into a savings account. Don't let your tax bill surprise you. So hopefully this video helps. If you found it helpful, go ahead and give this video a like for me so it reaches more people. Also, subscribe to the channel for more information that helps you save on taxes and grow your wealth. And with that, my name is Karan, and I'll see you in the next video. Take care.